Welcome, everybody. It's really great to be here. India goes before China as the first one. As with all things India, nothing is simple, thank God. People require us, they need us, and it's becoming more and more important for lawyers to be consulted in India. It never used to be there before 2000, and I'll talk about that more if you want to. The reason for that was it used to take 35 years to get a claim settled. It's becoming significantly better now. So some economic and political facts. I think the only fact that I'd like to point out here is one is the population. I think we're going to sort of be more populous than China very soon. And the second is the ease of doing business. I think we're jumping sort of spots very quickly. And the rationale for that is the new insolvency laws, the new incorporation of companies, streamlining of regulation, and more transparency. The insurance industry, I was just reading today while coming here, the penetration has actually increased significantly. There's been a huge jump in gross written premiums in the GI side. This 2017 figures, because IRD has not published the 2018 and 19 figures as yet. Expect bureaucracy in India. There's no doubt about that. M&A deals, this is misleading up to a certain extent. The rationale being that India opened up its sector in 2014, increasing foreign direct investment from 26% to 49%. So these 10 M&A deals include the increase in stake or exits by some of the minority shareholders in insurance companies. The number of insurance companies, pre-2000, we had 4 GI, 1 reinsurer, and 1 life. We today have approximately 50 insurers. It's still very small. Compare it to China. I believe China is over 400 at the moment. And compare it to pre-nationalization of insurance, we had 700 insurers in India. So huge amount of scope as far as India is concerned. And my assessment is, and this will come separately in the slides, is that as India opens up its market even more and the depth of insurance and penetration of insurance increases, you're going to see more and more insurers coming in. Recent reforms, it's a key focus area of the government. And I just sort of spend a couple of minutes on this bullet point. The reason why I want to spend a little bit of time on this bullet point is because the government is looking at the insurance industry for providing depth in the debt capital markets of the country. We as a firm have been involved very, very closely with policy implementation and formation as far as pensions and insurance is concerned. The issue that we've got in India is that debt in India, long-term debt in India is a 5-year paper. We don't have 30-year papers. We don't have on-tap bonds from the RBI. We don't have Reserve Bank of India is it's like the Federal Reserve in the US. So what we are working with the government to do, and the government has clearly made its made its focus as far as debt capital markets is concerned, is to deepen it. The rationale for that is previously what was happening is that you had the infrastructure sector being financed by bank loans. Those loans were a 5-year period, which meant that they needed to be rolled over. Anybody who's dealt with infrastructure knows that you have a 30 to 40-year time horizon. And to have loans given at 5-year periods with no bonds and no debt capital markets to access, it was becoming unworkable. The government has said that they're going to be looking at $1 trillion in the next 5 years as far as infrastructure is concerned. And it's looking at the insurance industry to actually finance that. It works extremely well, particularly from the life side, because you can match asset liability mismatches are rampant in India. And once long-dated bonds come in, then essentially what happens is asset liability easier to manage for insurers. Second wave of reforms was 2014. I talked about increase from 26 to 49. 2019 is a very interesting time. The budget was presented after elections, and in the budget, the government has agreed to 100% foreign direct investment in intermediaries. We've been working with the IRDA as well as the government in terms of the regulation itself. We expect the regulations for intermediaries to come in before the end of November, which means that it's a complete control for foreign investors. The differences, and when I say intermediaries, it's TPAs, brokers, loss adjusters across the board, any intermediary connected to the sector. The second reform that the government has announced is actually increase in foreign direct investment in primary insurers. And that is important because you, for the first time, will go beyond the 49% to majority controlled by foreign insurers in joint ventures in India. And therefore, it is, to my mind, path-breaking. The expectation for increase as far as foreign direct investment is concerned, don't hold me to this. Because the notification has still not been published by the government, but we expect it to happen in the course of 2020. Lloyd's is another interesting platform. We've just got one syndicate on the Lloyd's platform at the moment. The Lloyd's platform in India permits Indian-owned syndicates to be floated on the Lloyd's platform with very low capital. So to my mind, I mean, while we've talked to a number of syndicates to see whether a fronting arrangement can be done on the platform. Lloyd's doesn't like the word fronting. Indian regulators don't like the word fronting. But clearly, the ability to be for an Indian entrepreneur to float a syndicate on the Lloyd's platform in India and then reinsure back to the Lloyd's market or across the world does exist. We've not seen that happen. We've talked about this with two possible prospective clients. We are hoping that within the next 18 months, one of them will file. What's also happened is recently, we worked with the regulator to create the sandbox environment. You know, the London market is familiar with the sandbox environment. It is the most deregulated environment as far as sandbox is concerned. The other end of the spectrum is Singapore, where an approval is required before you can use the sandbox. India is now coming in between London and Singapore. So it's sort of free, but there is an approval requirement which goes through very quickly. Gift City, this is an interesting one. So 100% foreign direct investment is permitted for insurers in Gift City. What is not permitted is you're not able to write in the domestic tariff area, which is, so you can write insurance only in special economic zones, right? And the interesting bit here is that the Reliance Jamnagar refinery, which is the largest Indian corporation, and it has a single unit, is actually based in a special economic zone. So there is significant amount of scope as far as insurance is concerned, were you to consider coming in and establishing yourself in Gift City. IRDAs, I mean, anybody connected to India and insurance knows of the IRDA. I really don't need to talk about the IRDA. The Insurance Act is the key legislation. I mean, the IRDA publishes regulations under the powers granted to it through its Establishment Act and the Insurance Act itself. The IRDA has recognized in the recent past that its approval of products is causing a bottleneck in innovation as far as the market is concerned. And therefore, it is now moving towards a use and file procedure where you effectively can launch the product and then file the product for regulatory consideration. And once the regulator considers it, you may be required to alter the product a bit, but it doesn't stop you from launching the product in the market itself. The previous procedure was the file in use, which means there was an approval requirement. And now there are only very few products that fall within this category. Key issues as far as the sector is concerned, capital is scarce. Most joint venture partners in India, the insurers have now become larger than their flagship companies. Risk appetite as far as insurance is concerned is limited as far as Indian businesses are concerned, which means that Indian insurers are effectively starved of capital. So we were working with the government on this, and they've recently allowed a debt instrument to be floated by Indian insurers for investment into India. So you have the foreign joint venture partners have the ability to provide capital on a debt basis to the joint venture in India. So this is the first bullet point. The Indian owned and controlled regulation is an interesting one. While India liberalized investment by foreign direct investment from 26 to 49%, there was a requirement for Indian owned and controlled, which meant that the Indian joint venture had to be fully controlled by Indian resident citizens. We expect that this will be significantly diluted, and we expect that the IRDA is going to request or going to mandate that only majority of the board of Indian resident citizens, when they free up investments to 100% in intermediaries or majority owned in insurers. As far as existing product and tariff structures are concerned, almost all products are de-tariffed, but certain products like motor, for example, still follow tariff wording, and that causes significant issues as far as the Indian market is concerned. So it's when you're looking at products that have been de-tariffed, it's important to look at the wordings that are currently being used in the market and to assess whether they're fit for purpose. The IRDA regulates payment to intermediaries. It actually prohibits any payment other than that permitted. We've been talking to the regulator to free up this part and allow market forces to work in the manner that they should. The IRDA is now working towards a risk-based capital solvency structure. One would expect that to come in within the next 2 years. We believe that once RBC comes in, these payments will be deregulated. Our suggestions, our alternative suggestions to deal with this issue have not been accepted by the IRDA as yet. Reinsurers have been permitted under the 2014 liberalization to set up branch offices. We've got 10 reinsurers that have set up branch offices. So the likes of Allianz, AXA, Genri, so Berkshire Hathaway, etc. there in India. There is a requirement for a right of first refusal under the regulations given to Indian registered branch offices. So when you're looking at fronting arrangements or you're looking at a reinsurance market as far as India is concerned, this is something that you need to be aware of. In our experience, we found that this has not impacted the writing of reinsurance globally as it was done pre the regulations itself. The investment framework for insurers is highly restrictive. We've been working with the government again to liberalize this. We've been suggesting that for the insurance sector to innovate and develop, it is important to allow insurers to invest and take majority stakes in startups, for example, and insurtech companies. This is an interesting one. It's become better as far as claim handling is concerned, but the manner in which Indian policies are written is interesting because all coverage issues need to go to courts. Once coverage is satisfied and agreed, then there is arbitration provisions in the policy. Now, why is that important? Courts take about 30 years. Arbitration is mandated in the Arbitration Act to take 2 years, right? We've not, given that most of the wording is on the PNC side is effectively controlled by Indian state-owned insurers, we don't believe that the wordings are going to move on the PNC side. While on the liability side, the larger underwriters are private insurers. So AIG, Lombard, the joint ventures of AIG, Lombard, and Allianz. So we believe, and we're now pushing that this needs to be moving towards arbitration, and we are seeing that claims handling is becoming significantly better. We are also seeing that there is a huge amount of increase of claims. I mean, year on year, don't hold me to this, but our assessment is there is about a 300% increase in claims as far as DNO, PI, and ENO is concerned. I mean, notifications are increasing. We are seeing claims settlement increasing. We're seeing the quantum of claims increasing. So all three parameters. We find, and it's really good for us as a law firm, we find that there is a complete lack of awareness as to how claims ought to be handled by assureds. They believe that once they've bought an insurance product, I mean, once they make payment, they need to be paid. I call this the oh my God moment. So unfortunately, it doesn't work there, and God doesn't come to help. And so they come to us for assistance, which is nice. There's significant delay in notification, and which then means that there is significant delay in claims payment. This is interesting because a couple of times we find, I mean, Indian Limitation Act, for example, it requires if the insurer has not paid out a claim or not refused a claim within 3 years, it's barred by limitation. Now, something as simple as this, assureds don't know. And insurers also don't know. So we've come across a recent instance where after 4 years, the insurer rejected the claim. Had they just kept shut and not responded, it would have been barred by limitation. So we come across these things on a regular basis. Insurers tend to take technical defenses. Generally speaking, what happens is that the flow of work, claims handling in India is raise a claim, broker assesses it, forgets to notify. 1 month later, notification happens, claim is rejected. Assured goes and tells the insurer we are moving to another insurer. They engage, and 65% of the claim is paid and settled. This is the general procedure for claims handling. This is now changing significantly, and in significant ways. It's becoming more aligned to what I'm used to seeing in the London market. We are still not there at present, but I think it's moving towards that. I've talked about dispute resolution process becoming cumbersome. What I didn't talk about is insurance is treated as a service in India, and therefore, if it is not paid out, the ability for assureds to file claims before the consumer courts exist. There, the decision making is faster, but the judges don't know what they're talking about. So, you have to strategically determine where you want to go. Upcoming trends, new distribution channels, point of sales and agency networks are now being developed by insurers. Previously, they relied only on bank assurance. I've talked about file and use, I've talked about FDI. Sandbox is something that we are very excited about. I think there's going to be a significant amount of movement and development as far as, once insurers meet technology in India, and given India is one of the leaders of technology, one would expect that to be extremely good. Thank you very much. I've been shown the door right now by Amanda back there. I don't know who's next, but Jim, I hand over to you.
Yeah, thank you.